Welcome back, macroeconomists. Today we're going to be focusing on changes in the money supply and also fractional reserve banking. This is going to be a key part of your next test. You're going to need to know how to calculate reserve requirements, carry out fractional reserve banking, and then to see what happens to your money supply when the Federal Reserve implements different monetary policies. So the first thing we're going to start with is a graph. So this is the market for money. So this is the market for money. We have the quantity of money on our X. We have our interest rate and percentages on our Y. So we have 5, 10, 15. And we have individuals that demand money. We have individuals that supply money. We'll talk about each in a bit. So demanding money is individuals. So at a higher interest rate, why is the quantity of money so low? Because the interest rate is so high. You want to invest and deposit your money when the interest rate is low. So the quantity of money we want more money basically because the interest rate is lower. So a higher, again, it's just looking at the law of demand, but just implementing it to money. So the next thing we're going to draw in is our supply curve. Now our supply curve is fixed. So this is the supply of money. And let's just say it's like 700 billion. This is measured in billions of dollars. So this is a fixed amount. Why is it fixed? Again, there's only so much money in circulation, and this is where the Federal Reserve comes in. This is where they get to choose what our equilibrium interest rate is. So let's just say our equilibrium interest rate is 10%, where supply and demand intersect. Now, demand can shift if we demand more money, whether to expand our business or to purchase more products. This can increase your demand or your supply, and your supply can also shift. It can either shift to the right because we increased our quantity of supply, or it can shift to the left if we decrease our money supply. So we have a couple tools that we look at. We see our reserve requirement. So the first one, I'm just going to reserve requirement. So this is the percentage required by the Federal Reserve that each bank keeps an X amount of reserves in their banks. So if I wanted to increase our money supply, what would I do? So again, you can pause the video and answer that question or draw it in. So if I wanted to increase our money supply, I would decrease our reserve requirement. If I increased our money supply because we're decreasing reserve requirement, that means less money is being held in banks and more money is being lent out. So again, we'll look at our fractional reserve banking and how that plays out. So let's just say this is increase and this is decrease. And this is all for money supply. So delta money supply is the change in money supply. So if I want to increase money supply, I decrease our reserve requirement. Now, if I were to decrease this, what would happen is our curve is going to shift to the right. So now our new equilibrium point is here. So our interest rate is falling. So there's different effects of this. Now we're just going to do the opposite for the other. If I wanted to decrease money supply, I would increase our reserve requirement. Now the next thing is our, let's go with open market operations. So the FOMC, they conduct open market operations. So what they do, they either buy or sell bonds. If we want to increase the money supply, we want to buy. So if we buy, I'm just going to put buy and then sell for decrease. So if we want to increase the money supply, we're buying back bonds that we already issued. We're injecting money into the economy. So again, this would be a rightward shift. If we sell bonds, if we want to get money out of the economy, it's going to be selling and it's going to shift it to the left. Again, we're saying there's too much money in circulation. We want to scale back. That's something we would do. Now, the third thing would be the discount rate. The discount rate is the interest rate that banks or the Federal Reserve charges to banks in order to borrow money. So if there's a lower interest rate, that encourages borrowing. If there's a higher interest rate, it discourages borrowing. So if my discount rate is lower, increases money supply. If discount rate is higher, it decreases money supply. Again, this curve is going to shift accordingly. So if you're on this side of the column, it's going to be a rightward shift. If it's on the other side, it's going to be a leftward shift. Okay, the last one is the Fed funds rate. So Fed funds rate, this is the interest rate that banks charge each other to borrow money. So in this case, do I want to encourage borrowing or do I want to discourage borrowing? If I encourage borrowing, if I want to encourage borrowing, I'm going to decrease the interest rate, and that's going to encourage borrowing money. It's going to shift your curve to the right. Now, this is the opposite. If I want to decrease it, I would increase the Fed funds rate to discourage borrowing. So again, these are all important to know for your exam as well as your final. So what we looked at right here, this is all monetary policy. Now, we haven't talked about fiscal policy yet, but it's something that we've already looked at. Monetary policy is carried out by the Federal Reserve. Fiscal policy is carried out by the administration in office. So for fiscal policy, you can do two things. You can either change government spending or you can change taxes. Those two are fiscal policies. All of these are monetary policies by the Federal Reserve. So make sure you know that for the exam. All of this relates back to the ASAD model, which we'll talk about the week of the exam. So the next thing I'm going to show you guys is the fractional reserve banking. So I'm going to erase all this and give you guys an example. All right, class. So here we have our setup. We have First National Bank, Second National Bank. I didn't write out national, again, being lazy. So we have our assets and liabilities. Assets on the left, liabilities on the right. Some important information, your reserve requirement, RR, is 15%. So this is the amount that you're supposed to keep in your bank no matter what, determined by the Federal Reserve. Now our initial deposit is $50,000. So $50,000, that's our initial deposit. We're going to go from First to Second National Bank. So the first thing we want to do, is you have our deposits. Our deposits are our liabilities. So you're going to say you deposited $50,000 into your First National Bank. Now the reserve requirement is 15%, so we have to keep a certain amount of reserves. So in order to do that, all you do is $50,000 multiplied by 15%. So what you should get is $7,500. This is the amount that you should have left. So again, to get your reserves, it's just your initial deposit multiplied by your reserve requirement. Now, whatever we have left over, this is excess reserves. These excess reserves are going to turn into loans. L stands for loans, R reserves, D is your deposit. So to calculate how much we want to deposit, it's $50,000 subtracted by $7,500, and it should give us a loan amount of $42,500. This is how much we're going to loan out. So our initial deposit, $50,000. We only keep $7,500. The rest we're going to all loan out. So now this amount is going to be shifted to our Second National Bank. So now our initial deposit is $42,50. We want to calculate the reserves and we want to know what our loans are. Okay, so now it's going to be $42,500 multiplied by 15%, and from there, what you're going to get is $63.75, and from there, you're going to subtract $63.75 from $42,500, and you should get $36,125. So this is basically the setup. I could tell you to do this for up to 7 national banks. Again, it's just the same process over and over and over again. So you get your initial deposit, you multiply that by your reserve requirement, that's how much the bank has to keep. Each bank has to keep 15% of whatever is deposited into their bank. Then you're going to loan out the rest, and then we'll calculate our money supply. So now I want to know how much money has been created from our initial deposit. For that, we need our money multiplier. So MM is money multiplier. The formula is 1 divided by our reserve ratio. So in this case, it's 1 divided by 0.15. Just want to do the math again. 1 divided by 0.15. It's going to be 6.67. 6.67. I'm rounding. Okay, so now this is our money multiplier. Now we want to know how much money we've created. It's just going to be our money multiplier multiplied by our initial deposit. So the change in our money supply So $50,000 multiplied by 6.67, you're going to get $333,500. That is how much our money supply. That's how much money we created because of our initial deposit of $50,000 with our reserve requirement. So that's something you will be asked on your exam as well as final. Okay, now let's just say instead of 15%, the Federal Reserve says we're going to increase it to 20%. What changes? Basically, the things that are going to change, your reserve requirement. So each bank is going to have a different amount. Your loan requirement, your reserve, and your loan. And also your deposits as well, because if you multiply those, you'll have a different amount. So here, the Federal Reserve is saying we're going to increase our reserve requirement, meaning we want to hold more money at banks. So what can you kind of predict? Basically, that your money supply is going to decrease. Now, you want to know how much it actually decreased by? You would just plug in a new number here. So our money multiplier originally was 1 divided by 0.15, and that gives us 6.67. Now it's going to be 1 divided by 0.2. Now, in this case, it gives us 5. So now our new money supply, how to change our money supply is 50,000 divided by 5. Now, what that equals is $250,000. That's less than our initial deposit. So again, just be able to be comfortable with calculating this. Again, same setup. We'll do a little bit more practice problems during exam week as well as the final, but this will be a big part of it. So if you guys have any questions, by all means, drop a comment, email me, show up to the Zoom session. Other than that, that's going to be it for today. I hope you guys are doing well, staying healthy. So yeah, enjoy the rest of your day, and I will see you guys soon.